Have you ever been there? You buy a stock, a crypto, a currency pair, right as it smashes through a key resistance level, only to watch it slam on the brakes, reverse, and stop you out almost immediately? It is one of the most frustrating things in trading, right? Well, today we're going to pull back the curtain on why that happens and what the pros are really doing behind the scenes.
Welcome to AI Explains ICT. In this video, we're jumping straight into the deep end with concepts from Core Content Month 4, Episode 11. And hey, I'm serious. You might want to grab a pen and paper, because what we're about to cover could totally change how you look at the charts. Let's get right to it.
All right, so let's talk about the breakout myth. We're all taught the same basic strategy in a million YouTube videos and books. Buy the breakout, sell the breakdown. It seems so simple, doesn't it? If a price breaks an old high, it must be strong, it should keep going up. But we all know it fails like a lot. Why is that?
This is the million-dollar question we're tackling today. Why does it feel like the market has your number? Like it's specifically hunting your entry, reversing the second you click buy? I'm here to tell you, it's not bad luck, it's by design. The market is engineered to do exactly that, and it all boils down to one absolutely critical concept. And that concept is called liquidity. See, to really understand these sharp reversals, you have to stop thinking about old highs and lows as concrete walls or ceilings. They're not barriers. You need to start seeing them as giant swimming pools full of orders. This is the big mental shift, moving from a retail mindset to a smart money mindset.
And here is that difference in thinking, laid out plain and simple. A retail trader, they see an old high and their brain screams, "Buy the breakout! This thing's going to the moon!" But smart money, they see that exact same price level and think something totally different. They think, perfect. Look at that beautiful pool of buy orders. It's a perfect place for us to sell. They're using all that retail excitement to offload their huge positions at a great price.
So let's put a formal definition on it. A liquidity pool is just an area on the chart where a massive number of orders are all clustered together. Above every important old high, you've got a pool of what we call buy-side liquidity. And you guessed it, below every important old low, there's a pool of sell-side liquidity. This stuff, this liquidity, it's the gasoline that makes the market engine run.
Okay, so if we understand that, we can now start to understand the smart money playbook. They aren't just reacting to what the price is doing, they are the ones engineering the price moves. Their whole game is to push price into these liquidity pools so they can fill their gigantic orders without moving the market against themselves. They're either buying at a deep discount or selling at a huge premium. So, for a bullish setup, if smart money wants to buy a ton of something, they don't chase it higher. No way. Instead, they wait patiently for the price to take a nosedive below a clear old low. Why? Because that dip triggers a flood of sell-stop orders from all the traders who are long. Smart money then steps in, scoops up everything on sale, and then aims for the pool of liquidity waiting above a recent high. And the bearish setup? You got it. It's the perfect mirror image. If they want to sell, they wait for the price to rally and burst above an old high. That move triggers all the breakout buyers and gets everyone excited. Smart money then unloads their positions, selling into that buying frenzy at a premium price. And their target? That sell-side liquidity sitting right below an old low.
Okay, theory is great, but what does this actually look like on a chart? Let's check out some examples, because once you see it, you can't unsee it. This is where the light bulb really flicks on.
Just look at this. This one image basically sums up the entire concept. You see that old low? Smart money knows it's packed with sell stops, so price is deliberately pushed down right into that orange box to trigger all those stops. We call that a sell stop raid. But as soon as smart money has bought up all that liquidity, the real move starts, a powerful, aggressive rally straight up to the opposite pool of liquidity above the high. All right, let's get into a real-world case study from the ICT material. We're looking at the Canadian dollar, or USD CAD, and we're going to see this exact pattern play out in real time. So, the setup always begins by identifying where the liquidity is. Here on the left, we've got the daily chart. See that old low marked at 1.3102? Smart money knows that just below that level, there's a huge pile of sell stops from traders who went long. That becomes their target. And here's the rate itself. On the right, we're zoomed into a 15-minute chart. You can see price make this sharp, very deliberate move below that 1.3102 level. This move has one purpose and one purpose only: to trigger all those sell stops, absorb that sell-side liquidity, and let the big institutions fill their massive buy orders at a fantastic price. So once their bags are filled, the game totally flips. The new objective is the buy-side liquidity pool that's waiting way up above the recent highs. In this case, up at 1.3357. And what happens next? A powerful, almost straight-up rally. The market is just moving efficiently from one pool of liquidity to the next. What looked like a breakdown was actually the launch pad for a huge reversal. And here we see it again, this time on the dollar index. Notice the rhythm? First, a quick stab below a short-term low to raid the sell stops. Then, once those orders are absorbed, bam! An aggressive run higher to attack the buy stops that are just sitting there above those clean, equal highs. It's like clockwork. The market is an algorithm, and this is one of its core programs. You know, the goal of all this isn't just to teach you a pattern. It's to give you a whole new lens to see the market through. It's about shifting away from just reacting to price and moving towards anticipating where the liquidity is and how smart money is going to go after it.
So let's lock in these key takeaways. Remember, old highs and lows are not walls. They are magnets for price. The market is very often engineered to run these pools, and our job is to trade with that flow, not against it. So in a bullish market, you're looking for opportunities to buy below old lows, and in a bearish market, you're hunting for chances to sell above old highs. You're basically flipping conventional retail logic completely on its head.
I'll leave you with this one last thought to chew on. The next time you see a massive price swing, especially around a big news announcement, ask yourself this: is this move happening because of the news, or is the news just the convenient excuse the market is using to engineer a run on a major liquidity pool? The answer to that question will change everything for you.
Hey, if this video gave you a new way to look at the markets, do me a favor and hit that like button, and subscribe for more deep dives just like this one. Got any questions? Drop them in the comments below. A real person will get back to you. Stay safe out there and happy trading.